Hello and welcome to today's quick video, which is of course about macroeconomics, charts, meeting geopolitical risk and escalation in the form of strike on Iran. So much for the daily chart, where we saw repair of the post-CPI failure to go higher, move higher on PPI and unemployment claims, backing the message that these have been sending. I will not be diving too deep in this video into those implications. However, suffice to say that yesterday's call for equities to rise and go back clearly through the 6,015 and higher resistance, such as 6,035, meaning support, that has turned into resistance and was conquered to the upside. That came to fruition. All had been looking great, but in late hours we had seen the strike by Israel that had been successful, very successful in the opening stage. And in the early European morning we had seen second wave of that attack and no serious response, if you don't count 100 drones being sent Israel's way by Iran as a serious response. We had seen gradual recovery in equity markets. And of course, my quick geopolitical assessment, the more time passes without a serious Iranian response, the slimmer odds they have, and the more will equities trade again based on macroeconomics and the risk premium that we had seen come back into the markets and affect different asset classes differently will start evaporating, and we will be back to fundamentals and other aspects of trading. Suffice to say, this is the 30-minute chart where we had seen yesterday's spike construct what could be interpreted on a higher chart, meaning longer time frame, higher time frame, meaning, say, for example, 4-hour chart and so on. This could be interpreted as the right shoulder formation, and now we are somewhere around the neckline. Will we continue lower, or will this head and shoulders pattern be invalidated? That's the question. And the more time passes and the more intermarket clues we gather, the more reliable the conclusion would I be able to draw for you. For now, let's say that S&P 500 is stronger than either Nasdaq or Russell 2000, which are still below yesterday's pre-PPI levels, below yesterday's intraday low. The key winners have been, of course, gold, but it had been oil, and that's seen on the following chart. And trading signals clients had been ready with me expecting oil to be the single best performing asset well before yesterday's around yesterday's open, to be precise in time. And for now the oil price is still elevated. However, it's in a wait and see mode, in line with the politically military assessment that I gave you at the very open of this video. The more time passes without a serious Iranian escalation, that means that oil is likely to be retreating, because those Israeli strikes had been successful. This, of course, ties into the reversal of US dollar selling that had given way to retracement, especially in euro and then in yen. Will it be enough for US dollar reversal? That is another market closely on my watch. For now, I have a distinct bias when it comes to equities, gold and oil, and that's the subject of services given to clients.